Welcome back to JPX Energy Market Weekly Updates. Crude oil futures were most steady last Friday after several rounds of steep falls. In the short term, oil demand remains on demand despite rising inflation, while Russian supply disruptions and limited global spare capacity continue to crimp supply. The backwardation in prompt JPX Dubai, IC Brent, and NYMEX WTI intermonth spread in recent days has strengthened despite falling flat prices. However, with fears that demand destruction and recession continue to plague sentiment, price volatility is likely to remain high. Since the beginning of mid-June, the sell-off appeared not to have abated as investors continue to fret over potential recession after persistent high inflation. The U.S. Federal Reserve Chairman Jerome Powell has stated that the Fed cannot control the prices of oil or most food articles during his opening statement last week. Powell added that achieving a soft landing for the U.S. economy was going to be very challenging. His comments came amid an 8.6% year-on-year inflation in the United States. While the current tensions in the energy crisis are caused by a multitude of factors, the link with the global food prices should not be overlooked, as the market is still paying close attention to inflation rates. According to the IEA, direct and non-direct energy costs can account for 40 to 50% of total variable costs of cropping. For example, farmers use diesel fuel to run their tractors, and natural gas used to produce fertilizers applied on farms. Natural gas prices have risen strongly across all key gas consumer regions since early 2021, with the European and Asian benchmark prices hitting all-time records. Considering the fundamentals, the current tight conditions in global natural gas markets may continue in the medium term, and this would mean persistent pressure on operating costs for fertilizer producers, along with continued high prices for consumers. Nonetheless, the apparent demand loss from high prices has been offset by a solid demand recovery from the COVID-19. Oil demand seems to be less price elastic as expected. Asian gasoline cracks hit a record last week as a resurgence of car travel during the peak summer driving season following ceased pandemic restrictions. Meanwhile, the American Automobile Association said that it expects car travel to set a record with 42 million people hitting the road over the Independence weekend. Pent-up demand for air travel was supporting a near-term jet fuel outlook, with the International Air Transport Association reporting a wave of the international bookings since April. Most analysts maintain the view that the oil market remains tight at least before the fourth quarter, despite the current wave of pessimism. The evolving market dynamics come as the outlook for oil supply grows more worrisome in the medium term. Various international institutions have collectively warned a tight global oil production capacity due to a lack of investment last week. The International Energy Agency said that global oil supply could struggle to match demand in 2023 due to Russia's constraints, OPEC's production buffers, and China's need following its COVID lockdowns. EIA's newly released report shows that as of May this year, spare capacity in non-OPEC countries decreased by 80% compared with 2021 to about 280,000 barrels per day. About the 60% of the decline was due to Russia's constraints. Meanwhile, OPEC's spare capacity declined to 3 million barrels a day by May from 5.4 million barrels last year. Global spare crude oil production capacity in May was less than half of its 2021 average. The International Energy Forum also issued an update and assessment of various new factors exacerbating the investment crisis. The continued above-normal inflation is one of the factors. Higher inflation means that future capital expenditures must increase at a similar rate, at least to keep pace. Projects which had been previously received a final investment decision at some point last 2 years now face rapidly increasing costs, and projects which had been on the verge of final investment decision will likely be reevaluated. The continued above-normal inflation is one of the factors. Higher inflation means that future capital expenditures must increase at a similar rate at least to keep pace. Projects which had been previously received a final investment decision at some point the last 2 years now face rapidly increasing costs, and a project which had been on the verge of final investment decision will likely be reevaluated. In the battle against inflation, monetary tightening is compounding the already rising cost of capital. The oil and gas sector rely heavily on debt to help finance capital expenditures. Higher interest rates will increase the overall cost of a project financed from debt and could cause delays or deter investment in new projects. And some proposed policies to respond to higher energy prices include windfall taxes, regulations, and higher price volatility itself, all of which makes investment decisions more difficult. Okay, that's what we have this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.